Are you in the business game to win big? It's not just about revenue, it's about making every asset work for you. Today, we're diving into the power metrics, ROI and residual income. These numbers aren't mere summaries, they're the gauge of your management prowess. Picture this, your decisions impact your company's financial muscle. ROI measures how smartly you wield your assets, but it has a blind spot. Why? Because sometimes the juiciest opportunities seem less profitable on paper. That's where residual income swoops in, balancing the equation. It's about making decisions that grow the bank balance, not the percentages. But hey, there's a twist. These metrics aren't flawless. They can be sweet-talked, even manipulated. Ready to decode the financial game changers and navigate their strengths and weaknesses? Let's master the art of maximizing profits, one calculation at a time. In the financial world, ROI and residual income reign supreme as summary measures of performance. Think of them as your company's scoreboard, a single number that reflects how well you're playing the game. ROI, the golden child, simplifies it all. Operating profit, assets, divide. Voila, a percentage. It's the litmus test for managerial prowess, showcasing how effectively assets are wielded under your control. But wait, it's not just about the big picture. It's about dissecting the performance of every sector, division, or part of the company. Measure the effectiveness of asset utilization by crunching profit against managers' asset availability. It's the yardstick of managerial effectiveness, a tool that's undeniably powerful in its simplicity. Now, here's where the things get intriguing. Let's dive deeper into the intricacies revealed by these summary measures. First up, the nitty-gritty of ROI. The formula? Operating income. A bit messy, we admit. Divided by average operating assets. That's ROI for you. Hold tight because shortly, we're breaking down residual income. It's the operating income minus the required rate of return, or RRR, times average operating assets, neatly sorted. Let's ensure clarity. Average up those assets. Well, tidier equations make everyone's day a smidge better, don't they? Apologies for the slight detour. Let's keep this financial expedition rolling. Now, consider Nicole Simon, CEO of Simon Company, mulling over an investment. It's akin to contemplating a new venture, perhaps buying Apple stock or launching a French business line. This investment? It's expected to yield $20,000 annually but comes at a cost of $100,000 in required operating assets. A hefty sum indeed, tying up a significant portion of the company's resources. Let's break down Simon's move through a concise chart. Pre-investment, she anticipates generating $75,000 in operating income with $300,000 in operating assets. Post-investment, an upswing to $95,000, inclusive of the projected $20,000 annual addition. This translates to a total asset increase from $300,000 to $400,000, a jump of $100,000, comprising the additional $20,000 contributing to the $95,000 total. Clear as day, right? Now, let's consider the evaluation criteria for Simon. Assumed to be based on the growth in ROI. Not surprising, right? Everyone aims for an escalating ROI. It's the name of the game. After all, a bigger ROI means more cash in the bank. It's the ultimate efficiency indicator, showcasing how adeptly Simon harnesses her assets. So, let's break it down. ROI before and after. Picture this. After hinges on everything aligning seamlessly. The anticipated $20,000 return on the $100,000 investment in assets. Let's crunch the numbers, shall we? ROI before. Operating income divided by average operating assets. That's $75,000 divided by $300,000, which give us a 0.25 or 25%. Fast forward to ROI after, $95,000 divided by $400,000. Crunch the figures and you land at 0.2375 or 23.75%. So, if Simon opts for this opportunity, her ROI clocks in at 25% initially, but with the investment, it shifts to 23.75%. In Simon's case, the evaluation based on growing ROI poses a dilemma. We witnessed a shift from 25 to 23, a hint that pursuing this opportunity might not be the ideal move. Here's the catch: relying solely on these single measures can be a pitfall. While they swiftly gauge efficiency and asset utilization, fixating solely on ROI might blindside opportunities that could actually bolster company profits. Yes, these summaries paint a quick picture of asset efficiency, but here lies the downside: potentially turning down lucrative prospects in pursuit of a numerical goal. Residual income steps in to address this challenge. It's all about saying, hey, it's not just about chasing maximum ROI. Let's focus on smart, profitable decisions. Let's maximize those. Now, the formula for residual income? It's the operating income minus the RRR. Remember, that's the required rate of return. Imagine this. The company has a set amount to invest, limited opportunities and assets. They're discerning, saying, sure, this opportunity may yield a small return, but I can easily make that elsewhere. With a required rate of return set at 15%, they're essentially saying, we won't invest unless it promises a 15% return annually. That's where residual income swoops in, offering a different perspective. Let's tackle the next piece. Assume Simon's valuation is tied to the company's residual income growth. The company sets the bar at the required rate of return of 15%. Now, crunching the numbers, residual income before. It's the operating income of $75,000 minus the product of the RRR, which is 15%, and the average operating assets of $300,000. That gives us $30,000, a number, not a percentage. Remember, the goal here is simple: a larger residual income figure each year signals success. Now, shifting to residual income after, $95,000 minus the calculated value of $60,000, 15% of $400,000. That brings us to $35,000. Bingo! This showcases a higher residual income post-investment. The verdict? Nicole, Simon, go for it! This investment promises higher residual income, potentially a handsome bonus or increased profits if this venture is your own company. Worth the leap. In weighing the use of metrics like ROI or residual income, let's consider their pros and cons. The standout advantage of using ROI lies in its simplicity. It's a single calculation that encapsulates a lot about a company's operations. It efficiently gauges how effectively managers utilize company assets. It's straightforward, easy to explain, understand, and calculate. However, here's the catch: it's not infallible. ROI doesn't always paint the full picture. Take Simon's case. Despite the potential value, her ROI dipped, discouraging an investment. Here's the thing: these simplistic metrics can be manipulated. For instance, by not replacing old assets, the ROI inflates due to depreciating asset values. This gaming of the system highlights a significant disadvantage, sometimes leading to flawed decisions and potentially misleading results. So, while simplicity is a strength, the downside is the vulnerability to manipulation and incomplete insights. Numbers tell stories, and in the world of business, ROI and residual income narrate tales of strategy, risk, and opportunity. These metrics aren't just figures, they're your business's compass, guiding decisions and shaping paths to success. But they're not crystal balls, they're tools, and like any tool, their value lies in how you wield them. So, here's the million-dollar question. How do you navigate between chasing the percentages and making decisions that truly fatten the bottom line? Share your thoughts in the comments below. We're eager to hear your insights and experiences. If you found this exploration of ROI and residual income enlightening, hit that like button and subscribe for more deep dives into the world of finance and business strategies. Remember, the real game changer isn't just mastering these metrics, It's knowing when to go beyond them. Stay tuned for more tips, tricks, and financial wisdom. Until next time, keep strategizing and maximizing those profits.